Overall capitalization rate is equal to EBIT divided by value of firm into 100. What is structure? It is nothing but the sources of finance that the company raises from the public in order to run their business. In this capital structure theories, we have two types of theories: relevance theories and irrelevance theories. Hello everybody, I am your Divya ma'am, lecturing Vidhyaashram First Grade College, MYSURU, the Temple of Excellence. My dear students, today I welcome you all for this chapter 1, Capital Structure Theory. So in the last class, we have discussed about the cost of capital WAC problem, 15 marks problem for your examination. In today's class, let us look at the agenda, that is your capital structure theory, net income approach, and the problems based on net income approach. That is your UOM, that is University of Mysore, have put your chapter in such a beautiful way as you will be able to understand what is net income approach, what is NOI approach, why capital structure theories are very important in your financial decisions. So moving forward, let us understand what is capital structure theory. So capital structure theory is one of the major part of your financial decision. As a financial manager, it is the responsibility of the financial manager to take up the optimum capital structure so that the value of the firm increases while decreasing in the overall cost of capital. In a simple words, if I wanted to explain you people, my dear students, what is capital? Capital is nothing but the investment. What is structure? It is nothing but the sources of finance that the company raises from the public in order to run their business. So this capital structure is nothing but you're taking up the investment from the public. It is long-term sources. So it will be preference share, equity share, your debentures, as well as retained earnings. So which component is used, which structure is used so that the value of the firm increases, at the same time the cost of capital which associated while raising the funds, so that has to be reduced. So this capital structure theory explains you about the relationship between what is capital structure, why optimum capital structure is important, and what is the relationship between value of the firm as well as your cost of capital. So let us understand, capital structure theory is a major part of financial decision which affects the value of the firm. So your value of the firm should increase, at the same time, and how the value of the firm will increase? When there is decrease in the cost of capital. So when there is decrease in the cost of capital, the value of the firm increases. So which leads to change in EBIT and the market value of the share. So there is a relationship among the capital structure, cost of capital, and the valuation of firm. The value of the firm is nothing but in a particular market, what is the value of that share? What is the value of the share price, market price in that particular market? So the aim of effective capital structure. So what is the objective of a capital structure? So which type of long-term debt, long-term sources of finance should be used in your capital so that the cost will decrease, at the same time the value of the firm increases. So the aim of effective capital structure is to maximize the value of the firm. So as I have told you, which optimum capital structure, if they use a combination of debt and equity or the combination of equity, preference and retained earnings. So which optimum structure if they use so that the value of the firm increases. So this is maximize, to maximize the value of the firm. So that is the main aim of behind the capital structure. So to reduce the cost of capital. So mainly there are two types of theories. So there are two theories with reference to your capital structure, which explains the relationship between cost of capital as well as your value of the firm. Moving forward, let us look at what are the theories that we have to discuss. Capital structure theories. So in this capital structure theories, we have two types of theories, relevance theories and irrelevance theories. So in relevance theory, what it states, capital structure affects the valuation of firm. So if you're taking up the investment, from which source you're taking up, so that source, what is the cost that is associated, so that will affect on the value of the firm, the worth of the firm. So with reference to that, there is two theories, net income approach as well as traditional approach. And with reference to irrelevance theory, so what is irrelevance? Capital structure does not affect the value of the firm. So that says your irrelevance theory. Again, in that also we have two theories, net operating income approach and approach, that is your Modigliani-Miller approach. So these are the two important approaches that we have. So capital structure theory, mainly it is bifurcated into two theories, relevance theories and irrelevance theory. Why it is called as relevance theory or relevant theory? Because capital structure will affect the value of the firm. So it is relevant. So whatever the value of the firm, that depends on the capital structure decision. And the next is irrelevance theory or irrelevant theory. Why it is called as irrelevant theory? Because the theory says that the capital structure does not affect the value of the firm. So moving forward, so one by one we will understand what is net income approach, what is NOI approach. So this theory, relevance theory, in that NI approach is very important, and this will be asked in your examination for 10 marks to explain the theory. So whatever theory that is there, so those theories are based on certain assumptions. So whatever the scientists have given the theories, so those theories are based on research, are based on certain assumptions. So along with the assumption, if you explain net income approach or NOI approach, which is important for your examination, you will score good marks. Moving forward, let us understand what is net income approach. Net income approach is suggested by the David Durant. So according to this approach, the capital structure decision is relevance to the valuation of firm. So your usage of debt capital, increase in the debt capital will affect in the increase in the value of the firm. At the same time, the cost of capital will reduce. So that is what they are meant to say. So in other words, a change in the capital structure leads to corresponding change in the overall cost of capital. So your overall cost of capital will decrease if you use more debt finance in your capital structure. Why is this? The theory is explaining you people, because so what is the, how do you calculate EPS? What is this EPS? Earning per share. So how do you calculate EPS? So it is EBIT, interest, earnings before interest and tax. Next, what is the format? Deduct interest. So where do you get this interest? Interest is nothing but for the debenture what you people have taken. For that you need to pay what? Interest. So for paying that interest, you have to deduct from the earnings. So once the return is there, once the profit is there, they have to give back to the interest. They have to pay the interest. So after paying interest, what is left over? It will be earnings before tax. So next is you will deduct the tax. So your earnings will be there. So earning per share will be with you people. So next you will give it to preference shareholders. After that, the earnings per share. What is the earnings that you get after deducting interest and tax? So what is your you are paying interest and then later you are paying the tax. So here you need not pay more tax. So this is an advantage for you people, because after deducting the interest amount, on the leftover amount you are taking up the tax amount, you are giving up the tax amount. So that's why the cost will reduce. So that is what they mean in your NI approach. So what does NI approach says? In other words, a change in the capital structure leads to corresponding change in the overall cost of capital, so as well as the total valuation of the firm. So there is a relationship between, so there will be an effect between the valuation of the firm as well as your cost of capital. So use of optimum capital structure will reduce the overall cost of capital. At the same time, the value of the firm increases. So this has a direct relationship. So there is a effect. So capital structure has an effect on the valuation of the firm. So that is what your NI approach says. So according to this approach, use of more debt finance to reduce the overall cost of capital and increase the valuation of share. So that is what with example that I have explained you people. So what net income approach says? Net income approach says, so use of debt finance in your capital structure, so you can reduce the overall cost of capital, at the same time the value of the firm increases. So as I have told you, in NI approach, it is based on certain assumptions. So let us look at the assumptions. So there is no tax. So that in perfect market, so this situation will not appear because tax rates will be there. So the cost of debt is less than the cost of equity. So what they are assuming, the cost of debt to raise the debt finance, to take up the debt finance, the cost is lesser than taking up the equity finance. The use of debt does not change the risk perception of the investor. So the investors will not think that since the company is using the debt, so we need to get risk in the investment. So there is no such things. So there is no such perceptions with the investors. So all these are the assumptions. So based on this assumptions only, they are giving the statement that optimum capital structure. So usage of your capital structure will affect on the value of the firm, increasing in the value of the firm by decreasing the overall cost of capital. So let us understand the abbreviations. So what is this total market value of equity? So this stands for E. So symbolically it is represented as E. So total market value of debt, symbolically represented as D. Total market value of firm. So how do you get the total market value of the firm? D plus E. So your debt plus equity, if you add it, you will get a total market value of the firm. So I stands for your interest, so net operating profit or EBIT. So you have to understand all this before solving the problem. So how do you get value of the firm? So what is the formula to get the value of the firm? So your E plus D, that is market value of equity plus market value of debt. So if you add it, you'll get it, the value of the firm. So moving forward, so what is this? This is cost of debt, equity capitalization rate, and this is overall cost of capital. So this you have to understand. So this is the formulas that we will be, these are the abbreviations that we will be using in your net income approach. Moving forward, so this formula I have put in a tabular form so that it will be very easy for you all to understand. So how do you calculate? So in your net income approach, what they'll tell you to calculate? They'll ask you to calculate the value of the firm. So what is the value of the firm? They'll ask you to calculate V and the overall capitalization rate. So they'll ask you to calculate the overall capitalization rate and the value of the firm. So how do you get the value of the firm? As I have told you, market value of equity plus market value of debt. So if you add it, you will get the value of the firm. So how do you get this market value of equity? For that you have to add few things. For that we have to calculate few things. So what is the formula for that? Net income, net operating income, or EBIT, that will be given in the question itself. So less interest. So what you have to do? Less interest. You get earnings before tax. If you divide that with the equity capitalization rate, you get what? Your market value of equity. So when we take up the problem, we'll understand. So this formula I have put in a tabular form so that you might understand in a better way. Moving forward, the calculation of overall capitalization rate. So how do you calculate? So EBIT divided by value of firm into 100. So this is the formula to calculate the overall capitalization rate, and this is the verification formula. So the overall cost of capital is equal to cost of debt, the value of debt divided by value of firm plus cost of equity, or it is also called as equity capitalization rate. So E, that is your market value of equity divided by value of the firm. So this is the verification formula. Moving forward, let's take up the problem number 1 and understand how the net income approach problem can be calculated using the formulas. So a company expects to earn, so what they are earning? Operating income, net operating income of 3,60,000 annually. So it has rupees 12 lakh, 10% debenture, equity capitalization rate is 12%, and also calculate the overall cost of capital. So they've asked you to calculate what? Overall cost of capital as well as the value of the firm. So we have taken up the format. So in that format, let us understand in a better way. So what is given? Given is what? EBIT. So let us write down the given first. What is given? EBIT is given. So earning before interest and tax. So EBIT is given, and next what is given? 12 lakh. EBIT is how much? EBIT is 3,60,000. Next what is given? 12 lakh of 10% debenture is given. So what is the interest? Interest is, let's use the calculator. So what is given? 12 lakh into 10%, it will be almost 1,20,000. So 1,20,000 is your interest. What is the debenture value? The overall cost of debt value. What is the debenture cost value we have got? The debenture value we have got is 12 lakh. Next, what is given in the question? Equity capitalization rate is given. So this is symbolically represented as K subscript with E. That is your equity capitalization rate, 12%. So 12%, if you convert into your decimal, 12 divided by 100, it will be how much? 0.12. So it will be 0.12. So equity capitalization rate is given. So what they have asked us to compute? They have asked us to compute the overall cost of capital. So what is the formula for overall cost of capital? So just now we have discussed what is the formula. EBIT divided by value into 100. So what is the formula of overall cost of capital? EBIT divided by value of the firm into 100. So this is the formula to calculate. So we have done a prop format. So let's put the values according to the format and check out what is the answer. So what is the format that we have used? Particulars, then amount, what is the first thing we have to calculate? We have to consider net operating income or EBIT. So what is the EBIT is given? That is your operating income that is given. What is that given? 3,60,000. So what is the next thing that we have to do? Less interest. What is interest? That is given 1,20,000. So how did you get this 1,20,000 interest? So how did you get that 1,20,000? By 12 lakh into how many percent? 10%. So 12 lakh debenture of 10%, it is 1,20,000 is the interest. So 1,20,000. So 3,60,000 minus 1,20,000. How much it is? Minus 1,20,000. It will be 2,40,000. So what is this? Earnings before tax. And what is the next thing that we have to follow according to the format? Divided by equity capitalization rate. That is your cost of equity. Equity capitalization rate is given. So 12%, we have converted that into decimal. So 0.12. 2,40,000 divided by 0.12. So 2,40,000 divided by 0.12. The answer you get is 20 lakh. What is this 20 lakh? 20 lakh is according to our format. So this is 20 lakh is what your market value of equity. So now what you want to get this value of the firm, so you need to add the market value of debt. So how do you get the value of the firm? Value of the firm, you will get it by adding the market value of equity plus market value of debt. You will get the value of the firm. So this 20 lakh add market value of or value of debt. So what is the value of debt is given in the question? The value of debt is given in the question as how many rupees? 12 lakh. So 20 lakh plus 12 lakh, it will be how much? 20 lakh plus 12 lakh. So 20 lakh is your market value of equity plus your 12 lakh. It will be 32 lakhs. So what is this 32 lakhs? 32 lakhs is your value of the firm. That is your V. So this is how we calculate the problem. So now let us calculate what? Your overall cost of capital, overall capitalization rate. So overall capitalization rate, symbolically it is represented as how? K naught is equal to overall capitalization rate is equal to EBIT divided by value of firm into 100. So what is your EBIT given in the question? 3,60,000. 3,60,000 into 100 divided by what is the value of the firm? 32 lakhs. So let's substitute the value and check the answer. So 3,60,000 divided by 32 lakhs into 100, it will be 11.25%. So this will be the answer. This will be the overall capitalization rate. So we have this verification formula. So what is this verification formula? You can verify this. So whatever answer we have got, so that you can verify it with that formula. So moving forward, problem 2. So what is this problem 2? Let's read out the question. The expected EBIT of the firm rupees 2 lakh. So what is EBIT of the firm? That is 2 lakh. It has issued equity share capital with a capital equity capitalization rate 10% and 6% debt of 5 lakh. So what is debt interest that we have to pay? That is 6%. Equity capitalization rate is 10% and your EBIT is 2 lakh. Find out the value of the firm and the overall cost of capital. So in your NI approach, as I have told you, my dear students, in your examination, they'll ask you to calculate the value of the firm as well as the overall capitalization rate. So the next thing is given in the question. If the firm is issued 6% debt of rupees 7 lakh instead of 5 lakh. So instead of 5 lakh, if the company has issued 7 lakh with the same interest rate, what would be the effect? So what would be the position of the firm and the cost of equity? So let us solve the problem. So according to our format, we will solve the problem. So particulars, amount. So what is the first thing we have to see? We have two cases here. So case 1 and case 2. So we have how many cases? Case 1 and case 2. Let's consider this as case 1 and this as case 2. So what is given in the question? EBIT is given. So net operating income is given. So how much it is? 2 lakh. So 2 lakh, 2 lakh. Next, what is the next step we have to follow? Less interest. So for case 1, what is the interest rate? 6% on 5 lakh. So 6% on 5 lakh. 5 lakh into 6%, it is 30,000. And for your case 2, that is your case 2, 7 lakh, 6% is the interest rate. So 7 lakh into 6%, it will be 42,000. Next, after deducting this, what we get? Earnings before tax. So let's deduct it. So 2 lakh minus 30,000, you will get how much? 1 lakh 70,000. 2 lakh minus 42,000, you get 1 lakh 58,000. So 1 lakh 58,000. Now what is the next step we are supposed to follow? Divide this by equity capitalization rate. So what is equity capitalization rate given in the question? 10%. So 10 divided by 100, it is 0.1. So 0.1, 0.1. So let's divide the answer. 1 lakh 70,000 divided by 0.1, it will be 17 lakh. Next, 1 lakh 58,000 divided by 0.1, the answer will be 15 lakh 80,000. So 15 lakh 80,000. So what is this? This is your market value of equity. So I will continue in the next slide. The same thing, particulars, amount. The next is what? Add the market value of debt. Market value of debt. To get what? To get the value of the firm. So what is your value? Market value of debenture. That is 5 lakh and 7 lakh. 5 lakh for case 1 and 7 lakh for case 2. So let's add and check out what is the value of the firm. So how much? 5 lakh, 17 lakh plus 5 lakh, it will be 22 lakhs. Next, 7 lakh plus, how much it is? 15 lakh 80,000 plus 7 lakh. 15 lakh 80,000 plus 7 lakh. The answer will be 22 lakhs 80,000. So we have got the value of the firm. Now what we have to calculate, my dear students? We have to calculate the overall capitalization rate. So overall capitalization rate for case 1. So this is what your case 1. So what is the formula? EBIT divided by value of the firm into 100. So what is EBIT? 2 lakh is the EBIT. So 2 lakh divided by 22 lakh into 100. Okay, so what will be the answer? 2 lakh divided by 22 lakh into 100, it will be 9.9%. What is the second overall capitalization rate for second case? So overall capitalization rate for the second case is equal to, so what is EBIT? EBIT remains the same, that is your 2 lakh. So 2 lakh divided by 22 lakh 80,000 into 100. So let's use the calculator and check out the answer. So 2 lakh divided by 22 lakh 80,000 into 100, your value will be 8.755. So what will be the value? The value will be how much? 8.77%. So this is how you compute your problem under NI approach. So what does NI stands for? Net income approach. So my dear students, this is how we calculate your NI approach. So this is how we calculate the value of the firm as well as your overall capitalization rate. So I'll just move out of the screen, my dear students. We have solved 2 problems based on NI approach in today's class. Take up the screenshot for your reference, take up the textbooks and solve the problems based on this so that you can score good marks in your examination. To avoid the confusions, solve more and more problems. So if you solve more and more problems, you will get more confidence to attempt the problem. So this is very easy and a must problem in your examination under NI approach. Problem 1, problem 2. That's it, my dear students. Thank you so much for joining for this wonderful session. Hope the session was interesting, fruitful, and you have learned the problems under NI approach. In next class, we'll be discussing about the NOI approach, the theory as well as the problems. So until that, stay tuned, stay blessed. Smile is the biggest jewel you can wear. Keep smiling, people. Thank you.